Well, hello there, everybody. This is Morris from sjoptions.com as well as sjadvisor.com. Hopefully, you'll enjoy today's class. I did a lot of coding with my developer, and we have back tested one of Tastytrade's short strangles, and we used their exact formula from what I can gather from searching on the internet. So first of all, I did do a search in Google, and I found their 3 favorite strangle studies. And here there was one where they sold the 16 delta for the calls and the puts. And so I backtested exactly that. And then I also included their other rules, such as starting the strangle when the IV rank was 50 to 100%. And I also implemented the rule of managing or closing out those winners when they achieve 50% of the original credit, or stopping the loss when the original credit doubles. And so we implemented all those rules. The only rule that I couldn't find was the exact portfolio margin amount that they recommend for the trader to put into their into each trade. So I actually back tested several different amounts just to see how this would perform. Again, we get calls all the time, people asking if it works, if we could back test it for them. And so we spent the time and the resources to do this for you. Hope you guys appreciate it. It did cost several thousands of dollars, and I'm not backed by anyone, so out of pocket, free gift for you guys. So let me bring in some of the results. Just a second. Okay, so here I am at my website, and I just wrote this article. Again, if we find any of the back-tested results are not exactly accurate, then we'll, I guess, take the video down and redo it. But we've been working on the back tester for a while, and filtering out some of the data that didn't seem correct and getting it, as accurate as we could possibly get it. So the test was automated, and again, we use the same historical data, most likely that even Tastytrade has. I did go to their website and I searched Strangle, and there's 674 results. I guess most of those are videos. So again, they love the strategy, they teach the strategy, they're marketing this strategy, potentially to millions of traders. And question is, how good is this strategy? How well does it really perform? Okay, then I pulled a couple quotes just directly from their website. If there's one thing that we love discussing at Tastytrade, it's the good old strangle. Okay, it's been a popular topic lately. It's been, last couple of years since they presented Karen, the super trader. Okay, then I found this formula, again, right on their website, 16 delta call, 16 delta put, and so I decided to test that one. And then these are things that I wrote about the strangle. So again, obviously all you guys know what it is, but you're selling basically naked puts, naked calls at the same time. Some of you will argue that, it's a safe trade. In my opinion, it's extremely risky. You have nearly unlimited risk on both sides. And obviously it's, they teach the method where you have a stop loss, but then the other problem is you can't always rely on the stop loss, because sometimes you're going to have gaps, and then the volatility can shoot up really fast, just like August 24th last year. When that happens, then you'll go way beyond your stop loss and violate the rules. So even though there are rules, they're there to be broken, and they will be broken, especially with this trading method. Okay. So let's move down a little bit. Okay, so exactly what we tested in this back test, the Tastytrade Strangles. So one of their formulas, and they have a few that they put out, is they're selling the 16 delta on the puts and 16 delta on the calls, 45 days out to expiration. They're using an IV rank of 50 to 100 in order to initiate the trade. And then they're closing out those winners at 50% of the credit that they bring in, or they're stopping the loss if that credit doubles. Okay. Now, again, I couldn't find the exact amount. I don't know if anyone out there knows the exact amount of margin that they recommend to use in your portfolio margin account. Then you can email me or post a message, and that way I can test. But I tested various amounts of the portfolio margin account in our study. Also, we did test an extensive amount of time. So we did 2005 all the way to now, which is the beginning of 2016. So there were 11 complete years, as well as an extra month included in the test. So here are some of the statistics that we pulled from the report. You have a total of 69 total trades. Remember that a lot of the trades are not performed because the IV rank would be below 50. So we only did the ones following their guidelines. So we had a total of 69 trades. We saw 58 winners, 11 losers. There was an 84% win rate. The average winner was 12%, average loser 36%, again using the stop loss system. The maximum winner was 49%, and the max loser was 105%. Now remember, these are using your portfolio margins, which is the TIMS model. You can look at their website, but they advertise that they calculate the margins by measuring down 10% and up 10%. And so that's what we did. And now for some of the results. So I'll hide the rest. So we'll start down here. So test number 1, we use 15% of the portfolio margin. Again, if let's say your account is 100,000 and you have, let's say you have 100,000 buying power, then we only use 15%. Now, as a portfolio margin trader, if you're watching this, then you probably know that you don't use 15% of your account. Most traders, again, are aggressive about their investments and they want to make money. They're greedy. So all the PM traders I know are using between 30 and maybe 70% of their capital. So 15% is unlikely, but we did test that. And over the 11-year period, the strategy grew the account 33%. And again, it was 11 full years, so the average yearly rate was about 3%. And unfortunately for the strategy, that was the best that it ever performed. So now I'll bring in some of the other results for you to see. Okay, so we bumped up the next test to 25% of the portfolio margin account. And over the 11-year span, the trade resulted in an 11% loss, which was an average of 1% loss per year. Then we increased to 35%, and this resulted in a 15% loss over the 11-year span. And then we went to 50%, where, in my opinion, most portfolio margin traders are there or even higher, and it lost 80% over that period, averaging 7.3% loss per year. Let's take a moment of silence. Okay, so why would this happen? Okay, so just let me explain, my point of view of this trading method. I understand it pretty well, and I also understand the higher order Greeks that are involved with it, as well as the portfolio margin problem with this trade. Okay, so starting up here, the inherent problem with trading the Strangle on portfolio margin account is that when the market moves substantially, so let's say the market drops again 3% in a day, or 5 or 10% in a week, for example, when that happens, your volatility increases. This trade is heavily negative vega, so you get crushed from that increase in volatility, but at the same time, you're also losing from the directional move. And then while that happens, the margins go up. Sometimes they double, triple, quadruple. They go up an awful lot, and they go up really fast. Those of you that trade this strategy know. And if you traded it August 24th, you know exactly what I'm talking about. So this is a serious problem with the trade, just its general design. It has nothing to do with Tastytrade. It's just this trade, no matter how you structure it, what happens is the market moves down or up, but specifically down. When the market moves down quickly, vols go up, the P&L gets crushed instantly. Okay, so you can have a trade, again, let's say you have 100,000, you can quickly drop to like 70,000 just really fast. You instantly get a margin call. Next, I want to talk about some of their interviews. So I did see an interview recently where there was a computer programmer, and he came on there and he was saying he made like 50% in a year trading Strangles. And then he also commented that I think he blew up his account first. He had a different run where he did great for a year or whatever, then blew up the account and then started over. And again, it's typical. But I wanted to point out that, when they interview these people that are making tremendous amounts, it's, in my opinion, is highly hypocritical, because these people that they're interviewing aren't following their rules, right? They have, again, and they preach this to trade small, and it's because they know the risk involved, and they know that if you do get to 50% of your margin, you could blow up your account in one day. Okay, so they know, because they're the brokers, and they see all of their clients. They see behind the scenes, so they see hundreds of people over the years, blowing up their accounts left and right. So they know, and that's why they, put in those disclaimers all the time. Trade small. It's for their protection. But then they bring in these traders again, like Karen, a super trader, and that computer programmer. People claiming that they're making 50% in a year, but obviously they're breaking all the rules, because the only way that you could possibly make 50% a year is if you're investing at least 50% of your portfolio margin. And that'll work for a short amount of time, but you can see over the 11-year span, then it blows up the account. So again, do a search online. You could type in something like TD Ameritrade liquidated my account or something, and you'll find that it's happened to a lot of people. And I don't want that to happen to you guys, to people that follow us. So just be aware and do your own research, but you'll see that it's true. Okay, so back to this. The only allocation of capital that produced a return was 15%. Okay, but let's be realistic here. What portfolio margin trader is going to use 15% of their capital? and leave 85% free, right? That doesn't happen, so it's not realistic. But if you were to use as little as 15% of that capital, then it produced about 3%. That's only 3% per year on a portfolio margin account. That's pitiful. Okay, pitiful performance. So let's conclude here, get this wrapped up. And again, in our 11-year back test on SPX, we show that the beloved Tastytrade Strangle selling the 16 Delta, it doesn't actually work. We followed the rules to the T, and sure, it produced a 3% yearly profit using only 15% of your portfolio. But, you know, for all that work, I mean, the Strangle is a high maintenance trade. So, I mean, you're getting up every day, 6:30. Well, it depends where you live. But you're sitting there in front of your computer, constantly adjusting it, paranoid, you won't be able to sleep, and you're barely making what a bad advisor would make. So if it's worth it to you, then go for it, but that's really bad performance. Again, then when we increased the capital that was used, then it started to lose, and once you get up to like 50%, you're really at risk, and one bad year and you can wipe out that account really fast. So again, in portfolio margin, there are some awesome trading methods. We teach some very excellent ones. There's ways to use portfolio margin properly. This is not the way that you want to go about it. I also want to point out something else. Like, there's so many ways to tweak your reports, and I've seen it. Like when I backtest, I'll see some of the statistics, and then sometimes doesn't make sense. Like, you'll see a statistic where it shows that your average trade is a profit. Okay, let's say the average monthly trade was 4%. Okay, so you might see that in the report, but then your overall performance, your equity growth over the 10-year period, is actually a loss. And you wonder how that can happen when, again, how could your average trade possibly be positive, but then a long-term backtest be negative? Okay, so what happens is, as you're trading in real life, let's bring in 2008 as an example. If you, like in our test, we started 2005, so it worked okay, 5, 6, 7, and let's say it made 20 or 30%. But then 2008, what happens is you're facing loss after loss after loss, and then there are tremendous losses. And so you go through a bearish market, and by the time you get to the end of it and you come out the other side, your capital, let's say again you start over the 100, you might be down to 20,000. Okay, so now imagine you have 20,000 and you're successful in 2009, 10, and well, then 11 hits again. So again, 11 had some bad moments, and then 12, 13, 14, 15, let's say those were all good years, but the problem is you didn't have much money. So you may have taken the 20,000 and grew it to like 50,000, and then you have all these winners that might be averaging 4% a month, but you don't have as much capital now. So that's kind of what happens. And Tastytrade might show some reports and say, look, the average trade is 4% per month, and the probability is 80 or 90%, and show all these statistics. But once you throw them into real life and you go through the trading and you go through the adjustments, and your account net liquidation drops, it doesn't do you any good to make all those trades when you previously have lost all that money. And so again, you can show incomplete reports like that and make something look just totally different than what it really is. So in this example, I'm not showing you all these statistics like, well, when IV was at this level, then it came down to this and blah, blah, blah. And bringing in all those micro measurements, I could do that. But the bottom line is, how much does the trade make from, a long-term perspective? And if you implement a money management system like, they're teaching you, which I did, right? I've used a constant amount of money into every trade, creating money management rules. 10% every time, 15% every time. All right, so you have these rules, and you have your stop loss in place, and you have your stop gain in place, and you have all of those rules, the deltas you're going to sell, and so on. So follow the system. The system did not work, certainly not up to my standards. And it's certainly not what it appears to be. And again, it's so easy to show different statistics, but hide the actual performance of a trade. So I hope you guys liked that and learned a couple things about the Strangle. Why it may not be exactly what it appears to be or what it's advertised to be. Again, the important thing to take away from this lesson, a couple things. Like I said, when you're looking at those reports, really doesn't mean much when someone says I have 80% winners, 90% winners. It doesn't even mean a lot if you say your average winner is 4% and the average loser is 12%. Because, as I said, you may sustain enough of the 12% losers in a row, like for 1 year, and then your net liquid goes down, and then when you start to make all the profits, then it still could come out to a losing strategy. Even if your average trade is a winner, you can still lose money over time, okay, with some of these strategies. So hope you can understand that concept and take that to heart. The other thing is that the thing I want you to understand is with this trading method, again, it's a very strong negative vega trade, and it also has a very strong negative VAMA position. Again, did they ever teach you that? What does that mean? Well, again, as the volatility rises, that negative vega position that you start with gets worse and fast. It snowballs. So you might start with negative 10,000 vega, and it could move up to negative 50,000 vega. So as the volatility is increasing, your losses accelerate, and you might be down, let's say 5,000 1 second, then 20,000, then 60,000, then 200,000, like really fast. Okay, so those are things that that network is not disclosing to you. So you need to understand that. And then the other main point, again, is that when the market falls, your margins on this trade go up tremendously. I saw one class where Sosnov said they go up 30 to 40%. That's entirely absurd. It's wrong, right? I don't know if he hasn't traded, but it's totally wrong. You can just model it yourself. Put one on and then go, to August 24th. And anyway, start the trade on like the week before, on August 17th, and fast forward to the 24th. And measure 10% down at the beginning and the end, and you'll see it goes up like at least 100. It can go up overnight that much, so it doubles. Okay, so those are things you have to be aware of. Margins go through the roof simultaneously while you lose on the trade. Margin calls. Okay, so beware. All right. Anyway, hope you guys like the test. Be careful if you're trading it. I certainly wouldn't recommend that formula. I didn't test all their formulas. Maybe there's some that work. But this one is certainly not a good one. So take care. Again, this is Morris from sjoptions.com as well as sjadvisor.com.